So thanks for joining us tonight. And tonight we'll be talking about our fourth quarter 2021 US equity strategy focused on the big tech companies in the US. So we've already done this webinar before during our fourth quarter strategy a couple of weeks back, but we'll add on some more insights into this with regards to whatever happened in the past weeks, especially for the recent big tech earnings. So with me, we have Jonathan, who is the US analyst covering the internet sector. I myself cover the hardware sector, and we have Wei Ren, who covers the technical analysis. So our title for this seminar is called Secular Tailwinds in Tech. So we think that the underlying drivers behind the big tech companies are still intact, still continuing, despite the recent headwinds of rising interest rates. So our picture here shows the rocket boosters is still on. So just a disclaimer, this webinar is for information, and investors should do their own due diligence with regards to their investments. So just a quick review of the third quarter of this year, review of the performance. So it was mainly driven by interest rates, high interest rates for the third quarter. So the market took a breather. If you look at the bars, the percentage bars on this chart, it shows the performance of each of the asset classes for the third quarter. So the FANGM, the FAANGM stands for Facebook, Apple, Amazon, Netflix, Google, and Microsoft. The one you see at the top left-hand corner. So those are the big tech companies in the US, the largest tech companies. Then we have the S&P 500, the Nasdaq indexes, both the US indices. And then we have bonds, golds, and lastly commodities. So commodities are the one that will outperform the market due to the supply, due to the demand that came in when markets reopened from the COVID lockdowns. But the rest were mostly flat. The other assets, they mainly took a pause because of high interest rates. Because in September, the Federal Reserve actually signaled that they may raise interest rates earlier than expected, so 1 year earlier, and that caused a drag on all the equity indices as well as bonds and even gold. But if you look at the year to date, which is the orange box, the beige box, overall year to date, equity markets perform pretty well year to date still, especially after the recent recovery. So we can see that the big tech companies actually outperform both the S&P 500 and the Nasdaq. If we look at the sector performance-wise, for third quarter, financials outperform mainly because of the high interest rates, which will help benefit them to earn more from their loans, from their lending business. Whereas the consumer businesses took a hit, mainly because the programs, the pandemic support from the government in the US, the stimulus checks were tapering off during that time. So people have less money to spend, and so these stocks took a hit for the third quarter. But within the performance of the FANGs itself, we see that Netflix performed the best so far, and that's because of their recent results, showing that they had a boost in subscribers, and they also had a boost from higher prices of their subscriptions. And I think a lot of hype around their new Squid Game and they had another show, Squid Game. So it helped them boost their subscribers above expectations. But Facebook was down slightly at negative 4.8% at the other end. This was mainly due to the negative publicity of its whistleblowers and also impact from Apple's privacy updates, which we'll talk more about it later, that affects their ads business. Okay, but overall year to date, the best performer is Google. If you look at the beige box, up 58.7% this year to date. And then the second is Microsoft. We do not have coverage on Google so far, but we can provide you insight about Google and Microsoft. These two companies we do not cover at the moment, but we can still give you some insight later on. But we'll talk more about the companies that we have under our coverage, which is the rest of the FANGs. So the thing that has been on a lot of people's minds recently was the higher interest rates because of the higher inflation. It's one of the main reasons why the markets took a pause in the third quarter. So there's a lot of worry. But if we look back at history, back when interest rates spiked, so these are the periods you see the beige areas when the interest rate spiked. The interest rate is the red in color line, which is the 10-year bond yield in the US. So theoretically, higher interest rates should drag on the economy because it makes it harder for people to borrow money. So there's less money to be spent in the economy. But we see the relationship between interest rates, the higher interest rates and the markets is not so clear, because when the interest rate spikes, we see that the market can still perform during those times. So back in 2013, when the interest rate spiked up, we see that markets were not so volatile, and it even ended the time from the beginning to the end of the spike still up 7%. So the relationship is not so clear. We think that markets are driven more by economic conditions rather than interest rates. So the underlying point here is that the market can still perform when interest rates rise. And so the next macro theme that we're looking at is the valuations, because everything is at an all-time high at the moment. And there's a lot of worry that it may be like at a peak. But if you look at the valuations for the FANGs, the big tech companies, which is the blue line, the PE ratio. So the PE ratio is a gauge of how expensive they are at the moment. We see that it's near 5-year lows. So the blue line is near 5-year lows, as low as all the way back to 2016. So, and if we look at the red line, which is the broader Nasdaq index, it actually became more expensive relative to the FANGs. So what we see from this chart, what our point is that if you're buying the FANGs now, we think that you most likely not be overpaying, because the premiums compared to the broader market is quite narrow at the moment, and you're paying a narrow premium for the market leaders. So valuations still looks reasonable based on these historical levels. So we move on into the trends in the tech sector. We have this picture, the big wave, because we think that the trends that are pushing the big tech sector now is quite unstoppable, and they are still intact. So the first theme that is driving the big techs is cloud computing, and it's basically steamrolling. If you look at this chart, the blue bars is just increasing exponentially. I expected to grow more than 20% year on year, all the way until 2024. Main reason is because the penetration for cloud is still so low. It's only about 8% of the $3.6 trillion of IT spend per annum. So only 8% of the spending is in the cloud. So there's much more runway for cloud to grow. But for those of you that are unclear what the cloud is, so to put it simply is, so you don't have to purchase or build your own infrastructure. You don't have to build your own data center. You don't have to own your own computer. So you're using another company's computer or data center to run your IT applications and to store your data. So you don't have to have expertise to run your data center. You don't have to have security against hackers, again, to protect your own computers, but you simply just use a cloud provider's computers or data center to store your data, to analyze your data. And you can access this data anywhere in the world because it's accessible through the internet. And it's very cost effective. That's the main reason why cloud computing is growing so much, is that it's so much more cost effective to basically rent or use another company's infrastructure or computer or data center rather than building your own. And you pay by the second, you pay by the use of it. You don't pay for like an annual fee, you pay for the use of it. So for example, Netflix, like very simple example. So for Netflix, a lot of people stream their videos, a lot of people click, and a lot of people browse their website. And so this requires a lot of processing power, especially if millions of people stream their videos every minute. So, but Netflix doesn't need to buy its own data centers to run all these processes. So they just have to focus on the content that they produce, focus on the films, and they basically pay Amazon for their data centers so that everybody can watch their videos anywhere in the world, because Amazon has data centers all over the world. And another barrier to this industry that Amazon and Microsoft has is that every country has this law called the data residency law. So if you want to collect data, like let's say the email addresses or the addresses or data on a specific customers, you have to store and collect the data in the specific country itself. So that means that you have to have a data center in that specific country. And so it's very hard for it. Basically, Amazon and Microsoft has data centers all over the world already. And it takes a lot of capital expenditure to do that. And so we think this is a big barrier to entry in the cloud computing space. And that's why we see these companies growing so much at the moment. So as everything moves over into the internet, remote working and stuff, you would want people to be able to access their data through the internet rather than through a computer in your office. So you don't have to worry about your files being transferred. You can it's much easier to collaborate through the cloud where everybody has access to it. So collaboration is also another thing that is driving cloud computing. So just to give you a sense of the growth in cloud computing, Amazon's cloud business grew 37% in the last quarter alone. So they're growing faster than the overall cloud market. So that's just a testament to how fast this industry is growing, especially when all this Zoom and Netflix becoming more and more popular. Okay, the next trend we see is smartphones. Smartphones is a very mature market at the moment, but we think that the new driver is 5G. So it's a boost to unit sale volumes, first of all. So you can see on the chart on the left, the blue bars is increasing from 2020 onwards and expected to trend upwards again after several years of trending downwards. And that's because we expect people to start replacing their 4G phones with 5G phones as the 5G infrastructure gets built up. Not only that, but the telcos and the carriers, the telecommunication companies are pushing more 5G products, devices to customers, giving them more subsidies so that more people use 5G products, so that people will use more of their 5G services, which is more expensive. That's why they want more market share in that. So we think that this will continue to push demand for 5G unit sales. But we probably won't see the same amount of unit sales growth that we saw from 2010 to 2014 because the market is quite saturated. But the other very important thing for this 5G super cycle is the pricing of the 5G devices. So 5G devices can be more than 20% more expensive than 4G devices. So everybody will basically have to purchase a more expensive phone moving forward if they are buying a 5G phone. So this will help companies like Apple drive their margins higher. So that's so we see smartphone as another big trend in the big tech sector, mainly because of the 5G super cycle. Okay, on to digital advertising.
All right, thanks, Tim. So I'll be covering the next few sector themes. And the first would be digital advertising. We continue to see a secular growth trend in this space, which is mainly led by shifts in consumer behavior. Like nobody really reads newspapers or print magazines nowadays. We get most of our entertainment from our phones, tablets, or computers. And advertisers are kind of they also recognize this, and that's why they are also targeting moving their ads from your traditional print ads online to digital ads. The pandemic also accelerated this theme with more businesses moving online and kind of advertising online rather than kind of their traditional billboards or print ads. So if you can see this chart on the left, it's basically a chart of the digital. The red line is actually the digital advertising as a total percentage of total media spend, and the blue bars are essentially your digital ad spend on an annual basis. And so we can see that there's actually like a 14% CAGR growth rate for the digital ad spend for the next 4 years, which should drive digital ad growth moving forward. Right now, you can see it's only about 58%, 58 to 60% penetrated in terms of total media sales, total media spend. We do see this trend kind of continuing, moving on, and digital ads kind of gaining a larger portion of the total media ad spend. As of in the total industry, in the digital advertising industry, the two main giants are Facebook and Google. So most of the ad revenue or ad spend kind of goes there. Just a slight comparison, the ads growth is kind of growing at a 20% rate year on year, which is faster than the overall industry growth rate. But what we're actually looking out for right now is the emergence of Amazon, which Tim will kind of touch on later. So overall, digital advertising is not really a new trend, but more of a continuing trend that we see moving forward. So moving on to our next trend, which will be video on demand streaming. It's basically video on demand streaming is basically your Netflix, YouTube, things that are not linear TV, and linear TV would basically be your broadcast TV, your cable TV, things that we've always been using our whole lives, and for right now we see a continuing trend and the expansion of the streaming market, which can be seen in this chart on your left. So we see for right now it's about 60 to 70 billion. We expect it to grow at a 11% CAGR over the next 5 years. And this is kind of also led by consumer viewing preferences. So a lot of people nowadays, most people, I would say, kind of want like on-demand video. They want to watch whatever they want, whenever they want. They don't really want to wait for an exact timing to go and watch their favorite shows. And people also want a platform that has a larger variety of shows to choose from. So for example, Netflix has got thousands and thousands of titles to choose from. Whereas if you were to just watch your cable TV, maybe you've got like 100 channels going on at once. And so this definitely is pushing the trend away from your traditional linear TV towards on-demand streaming. So another reason for the growth in popularity is because there's actually better infrastructure. There's better cloud infrastructure to support content hosting. So basically means because of your infrastructure, you can kind of have a larger variety and a larger library of shows, and which basically makes your product better than what it was previously. We're also seeing increased broadband and mobile broadband coverage and speeds, which kind of provides a more seamless viewing experience for consumers without lagging and buffering. So overall, because there are kind of macro trends supporting the actual product of on-demand streaming, we definitely see this as one of the main reasons why streaming is becoming more and more popular. And this general trend actually bodes really well for Netflix and Google, just mainly because they are the main players that are in streaming right now. So moving on to our next theme, which will be antitrust regulations. There's actually been quite a lot of news lately on this, but the two main underlying issues that we're going to focus on is monopolistic practices and anti-competitiveness. So a quick explanation of monopolistic practices would be like M&As. M&As of, for example, larger companies that you buy up all your smaller competitors before they can actually challenge you, and thus maintaining this monopoly in your own industry. For anti-competitiveness, it's more of a what you do, or how much fees that you charge that prevent other people from benefiting from your service or from the overall industry as a whole. In general, for antitrust regulations, for most of what we can see, the kind of local regulators or international regulators just kind of fine their companies. We can see this over here. Facebook's got $5 billion fine. Google's got $10 billion. But for the most part, it's a relatively small portion of their annual revenue, so it doesn't really affect their business model that much. The market also kind of takes this as a one-off event. So there's the sell-off after your news, and then it kind of rebounds quickly after. We're a bit more worried when it comes to regulations that can affect business models, which is difficult to model, but it's definitely a concern that we see. We do see like new regulations and new laws starting to affect business models of some of these companies. So the latest case would be that we see would be the Epic Games versus Apple ruling. So Epic Games actually sued Apple because Apple forced all in-app purchases to run through the Apple Store, and they also charged like a 30% commission. So Epic Games basically argued and said that this is ridiculous. We have to pay such a high price, or rather, Apple, you're taking such a large chunk of what we're earning, and we don't even get a choice to kind of go around it and offer other solutions. So a judge actually ruled in favor of this, and now allowing app developers to kind of provide links for users to have alternative payment methods, which essentially bypasses the Apple Store. So this kind of could affect Apple's revenue because it reduces the amount of commissions that it can collect from these kind of transactions. So other antitrust cases that are ongoing, for Facebook, the main one would be the monopolistic practices. They are kind of FTC. They're battle with the FTC. The FTC really kind of wants to break them up, and this is because of they deem Facebook's acquisition of Instagram and WhatsApp to be monopolistic practices. And we also see Google's antitrust regulation, which is similar to the Epic Games ruling versus Apple. It has to do with their Play Store commissions. So I think that's it for our sector themes. I'll move on now to our stock picks. So for our first stock, we actually cover Facebook with a title that the core business is still growing. So we actually forecast MAP growth at 9% for this year. If you didn't know what MAP was, MAP is basically your monthly active people, which is defined as a person that has signed in or registered for Facebook's family of platforms within the last 30 days. Essentially, it's a fancy way of saying monthly users. And we already see that the year-to-date results, MAP is already up 8.5%, or rather, it's at 3.58 billion MAP users, which is very close to our year-end target of 3.6 billion. So not only is volume rising, but price is also rising, which is ARPP. ARPP essentially is your average revenue per person. So it's taking your total revenue for the quarter divided by your beginning and ending, your average MAP at the beginning and end of the quarter. Essentially, it's how much Facebook earns for each user that it has on the platform. I'm not sure if you noticed, like, whenever you scroll through Facebook or Instagram, you kind of get, you see more and more ads coming up. Instead of 1 every 10 ads nowadays, you've got like 1 every 5 or 6, 1 every 10 scrolls. Now you have one every 5 or 6 scrolls. And this is kind of how Facebook is generating more revenue. And the ARPP is actually increasing because they actually have a higher allocation of ad placements, as well as they've also introduced new ad formats like short form videos, which they can charge a higher price for. So their year-to-date ARPP is actually $24.29, which is 73% of our full year estimates of $33.46. Usually the fourth quarter is a bit stronger, so we hope that, and we're quite confident that Facebook will definitely hit our year-end forecast. So we see the growth in digital advertising as tailwinds for revenue growth for Facebook, especially because most of their revenue right now comes from ads. But we are also quite excited about their other growth drivers aside from their main revenue stream. And these are in e-commerce and AR/VR. So e-commerce was actually Facebook's fastest growing vertical last year, and the company is actually trying to monetize it moving forward. So we should see some kind of headway in terms of and ramping up in terms of e-commerce services on Facebook soon. Facebook has also spent quite a bit of money on AR/VR, so they have their own AR company called Facebook Reality Labs. It is a bit of a long-term project, but they're definitely putting quite a bit of resources into and investments into this. So our biggest worry or biggest risk for Facebook would be the Apple iOS 14 updates, which is actually named App Tracking Transparency. So this kind of gives Apple users the option to opt out of providing information to third-party apps like Facebook or Instagram or whoever. And it basically just limits the kind of data that Facebook can collect for its targeted ads campaigns, which could affect their revenue model moving forward. So actually, the lower quarter-on-quarter revenue growth for the third quarter of this year, Facebook actually attributed these to the updates, and I was mentioning how these updates were actually causing a lot of their ads to be less efficient, and therefore advertisers were less willing to spend so much money on the ads on their platform. But overall, we still see that the core business profits are still strong. The growth is still strong, and that's why we have a buy rating on it with a target price of $424. Moving on to our next company, Netflix. So Netflix in general is doing really well because pricing is up, subscribers are up, while they've been able to keep their content costs relatively flat. Paid memberships were up 22% year on year for FY20. And in the third quarter of this year, we saw memberships get a little boost from hit shows like Squid Game and Money Heist. For the third quarter, they actually increased 99% year on year, which is quite commendable. So for the chart on the left, we kind of have the relationship between revenue and paid memberships, and it's quite clear that the more members we have, the more members Netflix has, the larger the revenue. And on the chart on the right is basically the average revenue per member, which is the line in red, and the line in blue is the content cost per member. So we do that by dividing the total content cost for the year by the average number of members that they have on the platform. ARM is basically a fancy way of saying a pricing. It's just your average monthly revenue that Netflix gets from subscribers. And we can see that it's been increasing 6% CAGR from FY16. So that's a 5-year CAGR. So due to Netflix's subscription price hikes at the end of last year, we do expect ARM to jump 10% this year. And for year to date, ARM is already at $11.80, which is an 8% increase year on year. So they kind of have, for the fourth quarter, they only have about 2% left to go in terms of growth to hit our targets, which is quite interesting because it really demonstrates Netflix's strong pricing power. They're able to add users and while increasing prices, which is quite a feat in itself. So the rising prices on the chart on the right, the rising ARM and the flat costs, you can see that the gap between both lines is getting wider, and that essentially shows your margins. So you can see that, and we forecast that their net margins are going to grow exponentially moving forward. And this is due to the fixed cost structure that Netflix has, where most of their fixed costs, or rather most of their costs, are actually content costs, which are paid for upfront regardless of how many members they have. So essentially, once Netflix hits this kind of inflection point where they've got enough members to cover their content costs, each additional subscriber is just exponential profit for them. So net margins actually grew 5 times in the last 4 years, from 2% in 2016 to 11% last year. And currently, for this year to date, their margins are actually at 21%. But we do expect this to come down slightly because traditionally their fourth quarter their fourth quarter margins are pretty low in the single digits. So it should drag the overall numbers down to about 16 or 17%. So for Netflix, they also posted positive free cash flow for the first time last year. And this is actually a kind of a big milestone for them and for investors as well, because it allows the company to finally self-fund growth without too much reliance on debt. And it also kind of allows your potential for share buybacks, which is just pretty good for investors because share buybacks just generally boost your EPS and stock price. So we see like macro shifts in how people consume entertainment and preferences for more flexible entertainment options to provide like constant tailwinds for Netflix moving forward. And we have an accumulate rating on Netflix with a target price of $724. So that's all for me. I'll pass my time back to Tim to cover the rest of the stock picks. Thank you.
Yeah, thanks, John. Our next topic is Apple. The main thesis is the 5G super cycle. So we're seeing very strong demand for the iPhone 13. So the pre-orders very strong. Some of them need to wait more than 1 month. Although there is a supply constraint at the moment, but Apple did order more than 90 million units for the pre-order versus the normal 75 million that they usually order for a normal iPhone. So they do expect the iPhone 13 to see much higher unit sales, higher than the record sales back when there was a 4G upgrade cycle. So now they expect the 5G upgrade cycle to boost the unit sales again. But what's more important for Apple is the average selling prices. So the 5G devices, especially the iPhone 13, iPhone 12, are all more than 20% higher than the 4G models. So if you look at the yellow line, you can see that the average selling price for their products actually jumped up from last year, $690 average price per product to about $800 this year, simply because of the more expensive 5G products. And this will help Apple boost their margins. So with regards to Apple, the headwind for them is the supply crunch. But we think that the other competitors are faring worse than Apple because we're seeing a lot of suppliers put Apple in priority. They're prioritizing Apple simply because of how much demand they have and how big their orders are. So they're selling more than 200 million units a year, and that's why suppliers are prioritizing them. An added bonus for Apple is their share buybacks. So this is not new; they've been doing it for quite long already. But they've been putting about 70% of all their cash earnings into share buybacks, and this is helping to support the share price, which help investors returns. Another headwind is the Epic ruling for Apple, which Jonathan touched on just now. So what this does is that Apple cannot force people to purchase things through the App Store anymore. They used to do that, but now the apps can direct people out of the App Store to make payment. So Apple cannot take a 30% cut of whatever people spend on the App Store. They can't restrict that anymore. They can't have that exclusively anymore. But the impact of that may still be unclear. We think that people may continue to still pay through the App Store mainly due to convenience sake. So we're still monitoring, but this is we think is the biggest risk with regards to Apple's business model moving forward with regards to the App Store. So we think we haven't modeled this yet, but we think that a 4% impact on earnings could be the App Store. The App Store impact could be about 4% on the earnings. So we have a buy rating on Apple with a target price of 187. Okay, and our final stock pick is Amazon, titled Much More Growth Ahead. So Amazon has multiple tailwinds benefiting them at the moment. So the first tailwind is the cloud market, which you see there's still a very low penetration runway at only 4%, 8% of total global spend at the moment. And Amazon is the biggest cloud provider in the world with 32% market share. So we think that Amazon will be able to capture much of the growth in the cloud market that is forecasted, simply because they're the first mover. So they came in 7 years before Microsoft. And so in a recent ranking, from within the analysts and within the customers, Amazon was ranked by far the best in terms of capabilities and reliability. And not only that, they also their product pricing is very competitive, almost similar to Microsoft. So they provide one of the best capabilities and with competitive pricing. But more importantly is that Amazon provides the scale that is needed for to have big customers such as Netflix, Zoom, and even government entities, simply because they'll be able to handle all that data and handle all the geographies that these companies require in their businesses to scale. So we think that Amazon will be able to get much of the growth that is in the cloud market. The second driving point is that digital ads market. So basically, advertisers pay to put their ads on Amazon.com, the e-commerce website, so that people will see their ads and buy it. And so the conversion rate for advertising on Amazon is actually much higher than Google and Facebook. So Amazon is about 11% conversion rate, whereas Facebook is about 9%. So the reason why this is so is because Amazon has a lot of the shopper data that is very valuable. They know what people bought and they know what people want to buy, and so that makes it much easier to target customers who are looking to buy something. So the headwind for the digital ad market for Amazon is that the Apple's privacy update preventing advertisers to get data from Facebook's ads. So Amazon is not affected by this because Amazon only uses data gathered from its Amazon.com website, whereas Facebook usually gets your third-party data. It tracks you outside of Facebook.com, so they rely on your data that you don't only use on Facebook.com, and that's why it affects Facebook more rather than Amazon.com. So we're really seeing a shift of market share over to Amazon. So back in 2020, last year, market share for Amazon rose from 8% to 10% of the US digital ad market. To add on to that, Amazon is also adding more ad space, so more advertisements per page, and also a 30% higher price for the advertising. So we think these are big tailwinds for the advertising business. So if you look at the chart on the left, the cloud and advertising business make up most of Amazon's profits, the operating income. So the red in color one is the advertising, and the blue in color one is the cloud. So both of them make up about 50-50 of Amazon's profits, and they are expected to grow at 41% compounded annual growth rate in the next 2 years. The other thing is the e-commerce. The e-commerce is for their competitive mode. So the e-commerce is what allows the advertising to be so successful. So they are planning to expand the e-commerce by 44% in the next few years to about 578 million square feet, which is about 6 times the size of Amokyo, but 4 times the size of Amokyo. So they own 4 times the size of Amokyo of warehouses in the US. That's why they can deliver about 2 days or 1 day delivery. Yeah, so the competitive mode we still see is still growing for Amazon at 40% market share in the US. And we think that they'll be able to retain this simply because they're investing so much in it. So we have a buy target price of 4,329 for Amazon. Okay, so in conclusion, for our big tech outlook, we still see secular trends in tech, especially in the cloud space, in the digital ad space, and yeah. So these two things are, and especially the smartphone, also the new 5G technology is boosting smartphones. And we think that markets can still perform even though interest rates are rising. So as we can see historically, and the valuations for big tech is near 5-year lows. Okay, so but the headwind for big tech will be antitrust cases, which is but we think that so far it's mostly fines that these companies are facing, and none of them have been deemed as monopolies at the moment. So as long as they're not deemed as monopolies and the government doesn't break them up or impose any new regulations that impact their business models, then we think that the fines are okay. But it's a bit hard to model at the moment, the antitrust cases. We'll continue to, but we'll just continue to monitor it as we go along. Okay, we move on to technical views now.
Right, thank you, Timothy, for that, and Jonathan as well. So yeah, just the remaining of time we have, so I'll quickly go through the technicals review. So let's move on. Okay, so let me just so first of all, I think my view on the Nasdaq still remain the same. Out of the other three I mean, not including Russell. Look at Dow and S&P 500. We can see that Dow actually has really break new high, followed by the S&P 500 as well. Okay, so sorry, it's a bit sensitive. So let me go back. Okay, so yeah, okay, so for the S&P 500, for the Nasdaq, right? Yes, it did really cross a major resistance zone between 15376 to 15343 region. But the shooting star yesterday, right? Well, it is kind of like tempting to have some sort of minor pullback back into the Ichimoku Kumo, before a rebound to the upside. If there is based on the Elliott wave count, we can say 1, 2, 3, 4, 5. So that this is actually a one complete subwave cycle. We have ABC over here, and then we have a strong impulse move. But as long as it don't clear above 1570, we may see a slight pullback before going upside to target 16,000 target level. Okay. So, but in any case, if it has a strong sell down, I mean, which not entirely possible, we will see that 14750, this gap zone over here will be a very much good rebound zone going forward. So yeah, so right now we are just in a dilemma whether any upside is there for Nasdaq. Okay, so moving on to Microsoft. Microsoft, I'm still very bullish. First of all, I think price, I think Microsoft gaps up. I think pre-market it gaps up around 315 or something. I can't remember. Later I'll go and check. Yeah, 325 remain my short-term target level. Based on Elliott wave count, we are the intermediate phase of wave 1, 2, and this upcoming wave 3 is still yet to be completed. And then this 100 resistance zone is actually the extension level of wave 1 and 2 target level, which has been met. And then right now, after it crossed the support zone 1, upside has returned to the upside. So look at the Ichimoku indicator. Okay, so you can see that there's the long high wave candle. Correction at 123.6% essential, but the pre-market has really shows that it is really touching 161.8 near 161.8 region. So yeah, we might see maybe a opening gap and then filling up and then coming back. We test a support at 305 before rebound to the upside. Major long-term support between 290 and 296 is a major support that over the long term, should there be a longer correction, this is the area that you can consider over in the longer term. Another thing is divergence. Once market actually successfully closed above near 161.8%, we can see that this divergence threat, bearish divergence threat, will likely to be cleared and finished. So then the upside will just continue. Looking at Ichimoku, is showing a three bullish golden cross. So nothing to be worried about. Senko Span A just recently crossed above the high, so we are expecting much more bullish action ahead. The only concern is the thickness of the Kumo between Senko Span A and B. That's the only concern that we have currently at the moment. All right. So Apple, I think if you guys had joined the strategy and stopping on the US session, you can see that how much I love Apple. All right, based on technical chart. Also, I'm an iPhone user as well. And yeah, just that my PC is a Mac. Okay, but anyway, back to Apple. Apple successfully, like I shared that that last, despite the bearish Ichimoku showing, it is going tantamount, is going to break out of the range ball, and it happened. Short-term target the immediate resistance zone at 147 to 156 region. Consolidation, bearish pin bar. So we expect some sort of pullback, throwback to 144 region, this region at near the support of the range box before going up to a rebound. You look at intraday, sub waves or sub trend, you can see that there's a higher high, higher low, higher high. Maybe looking at higher low and then breakout. Okay, so you're looking at the wave theory of Ichimoku. You can see 1, 2, 3, 4, 5, 6, 7, 8. This is a day or change hand copy. And then we can see that 1, 2, 3, 4, 5, 6, 7, 8, 9. We have the 10, so plus and minus 1. We can see that there's one more correction down before going to the upside. So definitely we are seeing Apple in the midterm. We can see that it's going to target 157, and then go beyond that. We'll be looking at 184 in the very longer term target price, which Timothy has already put out in his report. I think back in August. Okay, so next one is Facebook. Facebook, yes, I did issue a report right after the stop and stop out but unfortunately I don't know why Facebook keep giving me false hope in the realm of technical analysis. You can look at initially it was successful. In fact, the gap up and then sustenance above the gap above the support term resistance zone 1 was like giving a good hope, but it just gap down. So in this impulse down wave move, okay, we can see that there's a bearish runaway gap. You can see that Kijun Sen is almost, if there's one more down move, you can see that Kijun Sen is going to cross below the Tenkan Sen. So this will give us the first give us additional confirmation. Okay, the bearish downtrend is here, and then we are looking at $300 perhaps for a stronger rebound to the upside. I believe that $300 will be the terminal support that will bring Facebook to higher price. Maybe just a slight false breakout, 290 region, which is this level over here. I didn't mark out, so sorry. So just use your eyes, a bit of eyes power to track out it. All right. Based on Elliott wave theory, we have completed wave 1 of the intermediate phase, minor phase A, B, and then with one more, we have a C around 300 region as well for Facebook. All right, Facebook, just that it is now going on the downtrend, especially it gets below both the Tenkan and Kijun Sen, just left over the bearish crossover. That's the problem that we have for Facebook right now. All right. So Google, initially I thought Google will be the better one because of the rounding bottom. It breaks out of the trend line. it has a deeper throwback more than I have. So yeah, so I think that instead of like going up the impulse to target 3,000 in the near term, we are looking at one more downside, maybe a corrective expanded flat or running flat. We may see 2006 being support. This gap zone offers a very strong support and buying power. So hence, we might look at a downside support for break to target 3,000. All this resistance level definitely going broken. So yeah, and then you can see that there's inverted head and shoulder, but normally inverted head and shoulder don't work very well in the continuation uptrend. It normally work at the bottom of the trend. All right, and then you can see the MACD just have a bearish cross. So once price make lower low, we can see that MACD is likely go back into a negative territory. Okay, so with that, I end off my presentation. I know some of you asked what are the cloud ETF they can buy, but I do stream a bit just now while Timothy and Jonathan is presenting. I can look at this counter called SKYY uptrend. Just there is a bearish engulfing candle right now, so you can wait for a pullback back to 110 or 108 to look out for a rebound. All right, so with that, we will go into the Q&A. I think there's a lot of Q&A and we shall not waste any more time. Yep. So back to you, Tim and Jonathan. Thank you.
Thanks, Wei Ren. So I guess I'll start taking some questions. Let me see. So for Neeraj, you asked, what time frame are you looking at for this projection? So most of our projections, or rather all of our projections, are for 12 months, because we mainly use a DCF for it. The next question, what is ARPP? I think I mentioned earlier, ARPP is the average revenue per person. So it's basically taking your revenue for that quarter or for the period divided by the number of people or number of users you have in that period. Can I share more on the metaverse? So yeah, the metaverse is actually something that Facebook has been talking about for the last few quarters. I think beginning the end of last year. It's basically like your what they're portraying it is that it's like your new age. It's basically what our web browser experience that we have right now. It's basically what we thought it would be maybe like 25 years ago or 30 years ago. So it leverages a lot on AR VR technology. It's kind of like a more immersive, or they kind of want it, the company wants it to be a more immersive experience, like social media experience or whatever it may be, your commerce experience. And it's just something that they believe will be the future of the internet experience, maybe 20 years from now. But other than that, it's a bit abstract for right now because we don't really, it's difficult to envision, but it's definitely something that could be big in the future. So the next question, what do you think of the impact on Disney Plus, etc. would have on Netflix? Especially when Disney is gradually denying content sharing with Netflix. So this is actually quite a good question. Just for comparison, I think Disney's ARM is about $4, $4 compared to Netflix, which is like 3 times more, almost $12. So there is already kind of a disparity there in terms of what they're actually earning from their streaming business. So Disney actually, their numbers, I think they've got about 110 million subscribers compared to 220 million for Netflix. So it's almost half. But most of their subscribers are actually they kind of acquired them through their Disney Hotstar launch, which is a really I guess cheaper subscription plan and subscription service that they launched in India and other regions in the Asia Pacific region. So it's a little bit inflated, but it's, I guess, still a good number. In terms of Disney gradually denying content sharing, so Netflix has actually been spending quite heavily on purchasing content assets and producing them themselves. So as of FY17, only 19% of their total content asset was produced in-house. The rest was like licensed, from Sony or from Disney or from whoever. So right now it's about 50-50. So you can definitely see like there's this trend where Netflix is trying to produce more and more of their own content. So I think they are also aware that they rather not rely on other people, other distributors and other content producers for their own content. And so that's why they're actually investing heavily in their own productions, which a testament to the quality of their productions is you can see it this year. I think they won like 44 Emmy Awards, which is the most by any production company in history this year in the third quarter of 2021. So yeah, that's my answer on Netflix. Oh, here we have is Disney Plus still a threat to Netflix? Yeah, I mean, definitely Disney Plus is still a threat because they have quite a foothold in terms of like your younger viewers, especially for your animations and your kids productions. So and they also have a lot of other shows that they produce on their own. But in terms of Netflix was basically the first mover. They have a stronger network in terms of subscribers. They definitely have the better user interface. Their shows are getting better and better. So we still see Netflix as the leader in video on demand streaming, and they're definitely well positioned to maintain this moving forward. So we don't actually. The next question: what's the target price for Google and Microsoft? We actually haven't covered it yet. We haven't initiated coverage, so we don't have a target price out for it. I guess. Oh, there's one more in the chat. Can you explain what is actually happening in Facebook? This is kind of a long explanation. Maybe I'll let Tim to answer some of the questions, and then I'll get back to you.
Okay, sure. There's a question: will the chip shortage affects Apple revenue? So Apple will be announcing their results on Friday morning in Singapore. I mean, it'll be at night for US. So the chip shortage actually is affecting the iPhone 13 currently. So that's why their lead times are so long. People have to wait like more than 1 month. But the contributions from iPhone 13 into the third quarter, into the upcoming results that Apple is gonna announce on Friday, it's not really gonna show up yet because they only launched the iPhone 13 in late September. So it's not gonna show up in the numbers yet. So I don't think we won't really see much of impact I don't think we will see much impact in upcoming results. And with regards to the supply chain, I think I mentioned it that Apple is faring better than the other competitors, first of all. But second of all, we think that the 5G super cycle is going to last longer than this chip shortage. So even though Apple can't deliver as many iPhones if they are like, let's say they're more affected by this shortage, we think that it will just push the demand backwards by maybe 1 quarter. So the demand will still be there, just that the supply will just be pushed back. So the super cycle thesis is still intact, just that it's been slightly delayed due to the shortage. So the shortage we think is temporary, and it will normalize after a while. There's a question about any listed security firms that we can look out for. We don't have any security firms that we cover at the moment, pure security firms. But if you think about the cloud providers, they are security firms. So let's say for Microsoft, but we don't cover Microsoft. But for Microsoft, what they have now is the cloud service. So the cloud service comes with the security service also. And so does all their Microsoft 365. So they do have this add-on security service that people pay a subscription for. So of course, Microsoft and all their cloud services do have security aspects within that, and they do charge customers for that. So it's sort of exposure to the cybersecurity market as well. In the areas of cloud services and software, there are a few new companies with high valuations. Any thoughts about them? I'm not sure which are you talking about, so this one is quite unclear. But we only cover Amazon at the moment, which is the only cloud provider we cover. So Amazon is the leader in the cloud service market, and we think that with regards to getting exposure to the cloud market, we think that Amazon is a good pick with regards, because we think that they're going to capture much of the growth that comes from the cloud market. In your view, will the current supply issues greatly affect Amazon's upcoming result? The supply issues may impact the sellers on Amazon's e-commerce website, because they may get like lesser stock to be able to sell during the festive season. Right? So they probably see lesser sales on Amazon, especially during the holiday season. So that may impact Amazon's e-commerce business. But we think that the profits are mostly driven by the cloud and the digital advertising business. So the current supply issues may impact Amazon if advertisers choose to spend less on advertising spending, and people sell less on Amazon. But we have to wait and see about the results, how greatly it affects them. Okay, there's a question: what will be the likely Apple EV car expected to release to the market? Yeah, so there's this speculation that there's this iCar that Apple is working on, but I think it's still pretty long ways away. I think rumored to be about 2 years away still, so not so soon.
Tim, I can take a few more questions.
Yeah, sure.
Right. So right here, what does the regulator do with the fines? So actually, for the FTC, right, whenever they fine anybody, all the fines go into the US Treasury. So likewise for the European Commission, everything goes into their treasuries. It doesn't actually go to the regulators themselves. I'll try to take this one. What's your view on China big tech stocks? And so would Alibaba, Tencent, or any other Chinese tech be a threat? So we actually don't cover most of these Chinese. We haven't covered most of these Chinese stocks at the moment. But given the circumstances that they've had such a big crackdown on big tech in China, it'd be difficult to see, because everything is so unclear. It'd be difficult to compare and to kind of see whether they'd be able to actually be a threat to the FANGs at this point in time. So anything can change in the next couple of years, but we'll definitely see how it goes. I mean, they are in their own right, they're also pretty large companies. I mean, their market caps are huge. So yeah, I mean, that's as much as I can say about the US tech. So I'll go back to the Facebook question. So Facebook just put out their earnings on Monday night, and the earnings was actually they missed on their revenue compared to market estimates of market consensus. They missed on quite a lot of metrics, but the main one that they did beat is their EPS. I think they beat the market consensus by about 5 cents. And this it's a bit tricky because they actually did they purchased like $14 or $15 billion worth of shares. They did a massive share buyback a program which boosted their EPS. So it probably looks a little bit distorted when you look at it from that perspective. But in general, they've had quite a lot of bad press with the whistleblower, the Facebook files, and all that. But I think the main concern that the market has right now, and we're seeing that in the stock price, is that that Facebook actually came out to say that the Apple iOS changes is affecting their revenue dollars and that growth, and they gave a really weak outlook for growth in the fourth quarter. And I think it kind of spooked a lot of investors, and that's why there's still this there's quite a bit of cloud around what's going to happen to the company which you can see in the stock price. But yeah, I mean, they also the company also did mention that most of they believe that most of the effects from the Apple iOS changes have already taken place, because most of the people that had to upgrade from iOS 13 to iOS 14 did so in the third quarter this year instead of the second quarter when it was launched. And so they're looking at the fourth quarter in terms of how it directly affects them. The outlook is muted. Yeah. So that's kind of the backstory on Facebook. I hope that answers your question.
Okay, I'll take the questions. There's a question on the valuations. So in SGX, we think that PE ratio of 20 is very high. Even the bank's PE ratio 13 is considered quite high as well. How is it that the US stocks like Amazon, Google can have such a high PE, and yet the market still thinks these stocks are cheap? Does it make sense? So PE is you can't use it as a number in itself, because you do have to look at the earnings forecast, right? So if earnings grows very strongly in the future, then the PE ratio in the future will become very small, right? Because the earnings will become so big. So why the PE for the US stocks is so much higher, right? Is because their earnings growth moving forward is so much. Like for Amazon, they expected to grow about 41% earnings in just 1 year. Whereas DBS, we only see that loans growth maybe grow like 1%, 2%, those kind of things. So the difference between the PEs is mainly due to the growth forecast and the prospects that these companies have. That's why and these US companies have so much higher growth than some of the blue chips that we see in Singapore, and that's why the PE is so much higher. Okay, the next question. If I'm looking to invest for a longer time period, what are the top 3 picks that you would advise based on the shares that you've shared this evening? So we think that over the long term, Amazon will be a good pick, simply because they're in the fast-growing cloud market, first of all, and it's still very lowly penetrated. So there's much more growth, like room for growth for Amazon in this space. And so Amazon will be one of the picks. The second pick would be, I think, maybe Netflix. Jonathan?
Yeah, definitely will be Netflix, because in terms of regulations, they're not affected by any of it so far. And they're also kind of just starting out in their journey, in their growth journey, their exponential growth journey. So we definitely do see a bit more runway there. When it comes to Facebook and Google, it's a bit, even though they are massive companies that dominate the advertising market, that there is this sense that they're kind of maturing, and therefore their growth rates shouldn't really be accelerating that much moving forward. I mean, not to say that their 20% year-on-year growth is bad, but you're not going to get your 50-60% growth anymore. I don't think that you'll be able to see that.
Okay, so yeah, so I guess Netflix and Amazon will be our picks. The next 2 questions will be about the Federal Reserve. So what's your view that the Fed may raise rates, and how will it impact the market? And then there's another question. Rumors of an upcoming crash due to Fed tapering. Is it wise to buy US stocks now? So these questions is about the worry over rising interest rates, basically. So, but we think that this time is not. We think that interest rates, the tapering, will not really be a big knee jerk to the market for this time. First of all, because the Federal Reserve members are speaking to the media almost every day nowadays, and they are always updating the media with regards to when are they going to taper, how are they projecting, and this kind of thing. So the market is really in tune with what the Fed is thinking at the moment and what are their intentions. So we don't think that there'll be any big surprises with regards to interest, any knee-jerk reaction in the market. And secondly, we see that historically the market can still perform well despite rising interest rates, simply because the relationship, we think that it's more looking towards economic conditions that affect the market more than these spikes in interest rates. And we think that as the market reopens, the demand will in fact increase as the restrictions get lifted.
I got one more. Do you think Facebook will end up like Alibaba in terms of stock price? I think that's a bit. It's tough to say, but in my opinion, I don't think it'll end up like Alibaba. I mean, Alibaba has dropped like 50% in the last 6 months or so, 9 months, and that's it's quite a big drop and that's kind of due to very strict government oversight and crackdowns. For Facebook, we do see they're still the leader in or rather one of the leaders in advertising. Their revenue model is still strong. They're basically a cash cow. They can just keep buying back shares and boosting their own stock price at will. And so, for them to kind of drop by 50%, it would be a really big deal. And I don't think the U.S. government or the FTC is gonna impose any regulations so bad that it will cause a stock price drop like that anytime soon. Because not to forget that Facebook and Google are kind of in the same boat in terms of advertising, in terms of data privacy and all that. So it's really not just about Facebook itself. Yeah. Thanks.
Okay, I think we'll take one last question. Which is a better bet, Apple, Amazon, or Netflix? Okay, I think we will argue that Amazon is the best because they have multiple tailwinds. So the first one is the cloud business, which is they're the leader in the cloud, which is a very big tailwind at the moment. But the second thing is the digital advertising, because it's taking share away from, I guess, Facebook. As more advertisers shift over to Amazon from Facebook, I think that the Amazon's market share can actually grow even more. So they do have two runways available to them, and we think that the growth prospects for that is higher. Okay, so with that, I'll pass the time over to Darren